I spoke about in my last video about how to conquer your fear of entry and how to know when to get in. So I thought I'd talk about the opposite end in this video. So I'm going to cover the topic of how to know when not to trade, being able to identify when the market is not going to give you what you're looking for. We should be looking at the market within the scope of probability, because trading is not very certain. You will never be certain 100% if you're going to win or lose. So trading is a game of probability, and the way I like to view the market is you want to be able to identify where low probability setups would happen, or what the low probability conditions are. So how I like to usually look at the market is you have a baseline probability of what the market is presenting you with, and then the analysis that you then apply onto the charts either increases or decreases this probability. Being able to identify the sentiment of the market, what sort of probability and conditions there are, it can come down to a number of factors. One of these factors could be the news. What news drivers are presented on that day of trading, or what lack of news is there. Because trading without news can usually make the market consolidate, move sideways, and you don't really want to be trading in a consolidating market. That's very low probability. The market will just gyrate up and down, fluctuate up and down, and you don't really know when you might see a breakout, for example, or when you might start seeing the market trending. So it's very, very hard and difficult to try and trade in those conditions. But then there's the other side. On the flip side, there's too many high impact news. Now, these could be things, for example, FOMC, CPI, non-farm payroll, the Fed testifying or speaking. These are times usually when you want to avoid trading during and before. Usually in big high impact news drivers like these, you'll tend to see that the markets might consolidate. This usually means because the volume within the market has moved to the side. It's moved to the sidelines, as it wants to wait until after the news events has occurred. It wants to wait until the damage has been done in the market to then realign and position themselves. And that's usually when you start seeing afterwards the market then present a more favourable condition. Too many people do the silly thing of positioning themselves before high impact news, and realistically this is just gambling. Positioning yourself before CPI, for example. CPI is a really big news event and can really wipe out one side or the other. It can really take liquidity and move it a very large distance, and it's unpredictable. I don't know anyone who says that they are able to predict what these news drivers can do. So positioning yourself before these big news events is gambling. FOMC and NFP, for example, again, sometimes the day before or the sessions before, when the news actually comes out, the market can tend to consolidate. Another factor that might give low baseline probability is certain times of the year. Now, this will only come from your own experience in the markets, but some obvious ones, for example, could be the holiday period of December and January. Usually at these times of years, the volume is taken out of the market. And when there's low volume, there's not going to be much movement in terms of price. So if you were to trade during this time, it's probably best to make sure that your risk is dialed back and that you achieve or you target low hanging fruit objectives. This shows that you're respecting the fact that the conditions are low probability, and it's also good experience. Me, myself, there are times of the year where I would avoid trading, like August, for example. I think that in August the price action isn't very clean, but some people might beg to differ. Holiday periods, December and January, low volume, not very much movement. If you're someone who trades pairs like Forex or indices, you might find that sometimes these correlated pairs might decouple, usually meaning that one will go one direction and one might go the other direction, or one will want to be significantly stronger than the other and the other will move in sympathy. Being able to identify which market is the stronger and the weaker pair will help you filter out which market you want to avoid. You don't want to be in the pair or market which is moving slower or moving in sympathy from the other. It'll be really frustrating to enter that trade and you might even take a silly loss. These sort of conditions can create high resistance in price movement, and I think this is where you want to avoid trading as well, because high resistance movement can usually mean price consolidating or just moving sideways in general. And usually when the market will want to just move a little bit and then come back, move a little bit more and then come back again, it's not very fluid, it's not very dynamic movement. There's no displacement happening. And sometimes you might find this when there is no news drivers or when there is no volume in the market. It creates high resistance runs. When you see correlated pairs sometimes consolidating or inversely correlated pairs consolidating. So for example, if you see that the dollar index is consolidating and you trade Forex or indices, it might create a very high resistance liquidity run. These are quite frustrating and painful to be in, so I tend to avoid those sort of days when there's no clear direction on where the market's going to go. So after you've established this baseline probability of the market, your analysis will then add or subtract to this probability. Now the reason why I say it might subtract as well is because your analysis doesn't give you certainty that you're going to be on side in the market. There have been trades that I've taken where I could frame a trade for the complete wrong side of the market and I get stopped out. And this is normal, it can happen. But being able to identify heavily which side of the market is favoured to move is a good signature of a high probability setup. You want to be so heavily one-sided that you can't even think of a single reason why the market would want to move the other way. This is how you probably filter out bad setups going in the unfavourable direction. And then one of the final things I just want to say was apply the risk appropriately to the trade you're going to take. If you have a lot of confluences in your favour within your own strategy or analysis, then it might be worth applying slightly more risk. But if there are times where you don't see as many confluences or the conditions aren't as favourable, because remember that this is probability, it's a spectrum. It could either be okay, or it could be strongly favourable, or it could be absolutely rubbish. But how you see that setup is subjective. It's your own opinion, and however you see the setup fit for yourself in your own eyes, apply the risk accordingly. If you know that the market is slightly lower probability than usual, then it might be worth dialing back risk a bit. You'll thank yourself after you take the trade in case it feels a loss. Because remember, it's all about preserving the capital, preventing yourself from taking more loss than you should. The final thing I just want to say is try avoid taking low probability setups in general. There might be experienced traders and very skilled traders out there who are able to move very nimbly, very nimble, should I say, in these markets. And that's fine because they have the experience and the data to support that. But if you're still learning or you're new, then it's probably best to avoid them. Being able to realise and having the eye to see a low probability market condition is a very powerful skill. I actually believe that knowing when not to trade is just as, if not more important than knowing when to trade. And it's best not to force the setup in these scenarios. So that was everything I wanted to talk about in this video, and I hope you found it helpful. Just before I end the video, I just wanted to quickly mention that I'll leave a link to my Discord community in the link below. We host weekly webinars, and whether you're into Forex, indices, crypto, whatever, we talk about trading topics, and we have experienced traders in there who are giving amazing advice. So I'd really recommend joining, and I'll also leave a link to my Instagram below where I'm updating people on my own trading journey and what I'm doing. So yeah, thanks for watching.